this video, I will be discussing how to use the income approach valuation technique. The income approach uses a present value approach to take future cash flows or earnings and discount them back to a single value in today's dollars. For a house, you typically expect cash outflows in the form of maintenance, but don't forget that final terminal inflow when you sell the property. Another way the income approach can be applied to a house is to consider its value as a rental property. You sure can. Show horses are often leased for a year at a rate of about 1/3 of their sale price. The leaser typically assumes all costs of ownership during that period. Let's look at our non-horse example. In this example, buckle up, we have another long story. So, in late 2011, the Big Six sports company, Big Six, acquired a smaller manufacturer of sports clothing located in southern Arizona, Zip Sports Clothing, or Zip. The purchase price paid for Zip was $50 million. Big Six negotiated with the sole owner, Jeremiah Zip, for a considerable period of time, as they were concerned that he would like to start a competing clothing company after the sale. During the negotiations, management of Big Six, along with the management of Zip, agreed that there would be some loss of customer revenue upon the acquisition due to the natural tendency of some portion of the customer base to leave over time. It was estimated to be 10% of revenue in year 1, 8% additional in year 2, 5% additional in each of the years 3 through 5 after the acquisition. These estimates were predicated on the fact that Jeremiah Zip would not be competing against Big Six. The management of Big Six, along with the valuation consultant, estimated that if there was no non-compete agreement, then Zip would lose more customer revenue. These losses were estimated to be 35% in year 1 after the acquisition, an additional 10% in loss year 2, and an additional loss of 5% in each of the years 3 through 5. Big Six, therefore, required Jeremiah Zip to execute a 5-year non-compete agreement at the time of the sale of Zip to Big Six. Now Big Six must determine the value of the non-compete agreement for purchase price allocation purposes. So again, remember, because we have a business acquisition here, everything, including intangibles related to non-compete agreements, result in assets at fair value on the balance sheet. Big Six retained another valuation specialist familiar with non-compete agreements. The specialist obtained the following projected financial information about Zip from Big Six management. Based on the information provided, using a 9% discount rate with a mid-year convention, what is the value attributable to the non-compete agreement using the incremental or differential method? So the incremental or differential method is just a version of the income approach. So what they want us to do is take a look at what we think would happen with the non-compete contract, and what we think would happen without the non-compete agreement. We're going to compare the difference in cash flow from those two scenarios, discount that back, and we're going to say that's the value of the contract because that's the impact it had on cash flows. Okay, so we have this projected revenue, and then we have adjusted it to get down to cash flows. So remember, they told us that with the non-compete, we still thought they were going to lose some customer base. So if we start out with all of the customers, which would be 100% or 1, then we think we're going to lose 10%, so minus 0.1 or 10%. That's going to give us, equals 1 minus 0.1, gives us 90% of our customers that are going to be retained. In the next year, we thought we were going to lose an additional 8%, down to 82% retention. In the next year, we thought we were going to lose an additional 5%, which gets us down to 77. An additional 5% after that gets us down to 72. And an additional 5% after that gets us down to 67. So we believe that our discounted cash flows, I've given us our present value factors here because the mid-year convention is a little weird. So that's a 9% discount rate using the mid-year convention. And so we're saying that these are the projected cash flows with no attrition. we believe there's going to be a 90% attrition of customers. So that's going to be 90% of those cash flows. Or sorry, 10% attrition, 90% retention. And then we're going to multiply that by our present value factor to take that item and bring it back to today's dollars. Remember, today we're imagining it is 2011. Okay. We're going to do that across the board. So we're going to take each of those individual cash flows and discount them back to today's dollars, and then add them up. So we think that our present value future cash flows with the non-compete is $22 million. Now we're going to do the same thing without the non-compete. So without the non-compete, we thought we were going to lose 35% in the first year. So that's 1 minus 0.35 gets us only a 65% retention. Then after that, we thought we'd lose another 10%. That gets us down to 55% retention. And then another 5% after that. Another 5% the year after that. And one more year of 5%, getting us all the way down to 40% retention at the end. So again, we're going to do our present value future cash flows. So we're going to take our cash flows that we are projecting, multiply it by the percentage of customers we think we're going to retain. So that gets us to what the cash flow actually would be. And then we're going to discount it using our present value factor. And we're going to do that all the way across for our 5 years. And then we're going to add up all of those numbers to give us an estimated cash flow of around 15 million. So we're going to take the difference between those cash flows that we think we'll get with the non-compete versus the cash flows we think we would get without the non-compete. And that tells us that the value of our non-compete is about $7.6 million. Now again, I want to take a minute to point out how much estimation we've done here, or how many assumptions we've made. So let's think about all the places we've made assumptions. First of all, why is 9% the right discount factor? We don't know. Why is 5 years of projection the right amount of time? We don't know. Where did these numbers come from? How did the valuation specialists decide that those are the levels of attrition that we would have? We don't know. And on top of that, this entire income statement up here, or cash flow analysis, is also projected. Those are future numbers, and those are all guesses based on some level of assumptions. And so if we were doing a scenario analysis here, there are a lot of different assumptions we could tweak in order to try to decide, how sensitive is our estimate to, these percentages we picked here. How sensitive is it to our projections on revenue? If we're wrong on that, how wrong does that make us on the value of our asset that we're trying to value? So again, I want you guys to start trying to get comfortable with the unknown, with there being a lot of variation and a lot of judgment in these problems, because again, there won't be necessarily a right answer, but there oftentimes will be a wrong answer. This concludes our lecture on the income approach. Don't forget to email any questions for our discussion.